Welcome to the Kimberlite webinar that take a comprehensive look at the hydraulic fracturing market. My name is David Batt, President of Kimberlite Research, and I'm glad you can join us today. I'm accompanied by Andrew Thornton with Kimberlite Research, and together we'll take you through the 31st Kimberlite webinar hosted on behalf of the oil and gas operators who participate in our industry research. These webinars are provided as a professional courtesy and a thank you to the many oil and gas operators around the world who participate in the Kimberlite industry surveys. In past surveys, we've discussed the global drilling services market, artificial lift, intervention services, subsea, and most recently, we've taken deep dives into the big four oil field service providers. Let us know if you or your colleagues would like access to any of these prior webinars, and just send us an email or chat message, and we'll get those to you. Also know that we often collaborate with the oil and gas operators worldwide. And if you would like to have any customized presentations for your organization, just reach out and let us know. Today, we'll be taking a deep dive into the hydraulic fracturing market, including updates on dual fuel versus electric, simultaneous hydraulic fracturing, and other technologies, as well as a competitive landscape, a review of how the hydraulic fracturing service suppliers stack up in terms of performance and service quality. Feel free to submit questions during the webinar through the chat box or email, and we'll try to address your questions as we go. For those of you that are not that familiar with Kimberlite Research, I'll provide a brief background and then dive into the review. Each year, Kimberlite conducts about 3,000 interviews with users of oil field services from around the world. Our research is about 50% North America and 50% international. From these 3,000 one-on-one interviews, we prepare a series of reports across formation evaluation, drilling, subsea, completion, and production. Today, we'll be talking about the hydraulic fracturing report that we update each year. Today's findings are based on 159 interviews with completion engineers and managers from over 100 different E&P operators. And the performance trends that we'll be sharing with you today from 2016 through 2023 are based on interviews with over 1,400 completion engineers and managers and over 23,000 supplier performance ratings. The data set is rich and multidimensional. In this exhibit, we cross-plot supplier performance on the horizontal x-axis against pricing strategy or pricing competitiveness on the y-axis. We'll be using this value map quite a bit today. So I just want to explain the four quadrants really quickly. Any oil field service company supplier that plots in the top right is viewed as a premium offering, costs more but worth it. The fair value fairway runs diagonally down to the southwest quadrant. Any oil field service provider, and the bottom left-hand quadrant is viewed as a discount provider. Bottom right, value advantaged. And any oil field service company provider that's viewed in the top left-hand quadrant is competitively disadvantaged and has an opportunity to either improve performance or perhaps adjust their pricing strategies. So with that, we would like to dive in. To kick things off, there's a lot of uncertainty in the market. Even though oil prices have been around $80 a barrel recently, today they dipped below. A lot of people feel like it's about $30 oil. Andrew, do you have any insights on what's going on out there?
Yeah, so thanks so much, David. So I like the word uncertainty, and the best way I can look at it is I look back at 2022, and then I'm looking at 2023. So if we look at our 2022 survey, we can see that about 75%, 3/4 of our respondents said, hey, the market's going to grow and we're expecting pretty healthy growth. Very few, if any, thought the market was going to decrease in over expenditure. 2023, different story altogether. About a third of the operators we spoke to believed that the market's going to increase. Nearly half thought it was going to stay the same. And now we've got nearly a fifth who suspected it may decrease. So we've gone from high certainty to high uncertainty and a lot more variability in answers. But a good way to look at this is graphically. So what we're looking at here is a diffusion index. So as you know, David, anything above 50 would show that the market's going to grow, or expectation that the market will grow. Right. Anything below 50 would indicate contraction. We go from the lows of 2020, severe market contraction, and then we've got 2021 and 2022, significant growth levels, north of 30%, and we'll see that again in a second. Almost unsustainable growth levels, quite frankly. Now we've got an index above 58, growth, but at a much more moderate level, which is part of the reason people are they've got to become accustomed to these high double-digit numbers. And now we're back more into that single-digit growth. But even within that, we've got dispersion. You've got gassier plays like the Marcellus, the Mid-Continent, with some private E&Ps who are actually potentially even in contraction at this point in time. This is probably, again, a great way to look at it. 21 versus 20, 29% growth in terms of activity. That's drilling trends. 22, even higher, 36%. And now we're in this effectively ever so slight growth pattern of 2 to 3% overall. Now, why does it feel like $30 oil? Well, sometimes it's the expectation game. If we look at July of last year, everyone thought the market was going to grow 15%. And then everyone thought it was going to grow 12%. And then 6% in March. In our most recent study, it's now down to 2 or 3%. So that's, even though the market's growing, that expectation has certainly moderated overall. To this, now, we look at what we're expecting in 2024. So that was 23.
Okay.
What's coming up? 2.9%. So we spoke to drilling engineers just a few weeks ago, quite frankly, and the expectation is for 24, 2.9% growth in the US land relative to 2023. Now, I get asked a lot, what does this mean for rig counts? Now, rig counts, here we can see them per quarter for the lower 48 only on the land side of things. 2023 and 2022 are almost the inverse of one another. So we spent the first half of 2022 adding well over 100 rigs. And in the first half of 2023, we've actually done almost the complete opposite of that, quite frankly, to get this lull.
So we've drilled as many wells year to date through 2023 as we did through 2022, or actually more.
Yes, but that's exactly right. The difference is that where that's happening within the year. Okay. So what's going to happen for the rest of the year is going to be an interesting question. Okay. Right now, we're saying that the rig count's pretty close to bottom. And then critically, to hit that 2.9% we saw a second ago, we're going to have to go back above 700 rigs. Now, there's some variability in the back half of this year. Will it go up or will it go down? But
we're hearing about some privates maybe wanting to add some rigs in the fourth quarter at these prices. So you think that's a possibility?
Yeah, I think that's a significant opportunity for them. If we look at oil price today around 80, we say there's a lag effect between oil pricing and drilling activity of 3 to 6 months. That would indicate in the back half of this year, we could see a few more rigs added in. But long story short, even if that does occur, we're still going to have to go back above 724, would be my estimation overall.
Okay.
So that's a good view on activity. But David, there's a lot of factors driving the market. So what do you think are the most critical things, the key drivers that are influencing?
Sure. There are many factors that are driving these activity observations. When we take a look at some of the pricing trends that the oil and gas operators have been, dealing with over the last year or two, you can see in this particular exhibit that pricing has actually increased to hydraulically fracture and complete a well by about 35% from the lows of 2021. And so, that's a fairly significant increase that's taking place. Now, with the softening in the market and activity that you just talked about, Andrew, you've got about half of the oil and gas operators in U.S. land expecting pricing to decrease and about 29% expecting it to remain flat. And depending upon the timing of these contracts and such, you have a few people that realize that perhaps their pricing may actually see some increases coming up, okay? So, certainly there's some changes there. But the one thing's for certain is that we don't really see a material collapse in pricing. The big four hydraulic fracturing service suppliers have opted to pull units out of the market in order to protect margins. But one of the biggest trends that's, I think, influencing the activity that we're seeing is the fact that we as an industry continue to work together with innovation, grit, and collaboration between the oil and gas operators and the service partners and the service companies. And we continue to see improved drilling efficiencies and completion efficiencies. This is even more pronounced when you go to the Permian Basin, where we're drilling these wells in 4% fewer days and completing them in 7% fewer days. And just to put this into perspective, we're producing as much oil today as we were pre-COVID, and we don't have 900 drilling rigs and 400 frac crews. So we're achieving more with less as an industry. And that really speaks to, again, how the oil and gas operators are able to benefit from these efficiencies, but also it emphasizes the need for the oil and gas operators to continue to partner with their service providers to continue to drive these efficiencies, because this is really a remarkable outcome for our industry. Sometimes people ask me, what's the silver bullet to these efficiencies? It could be as something as a sand management system with top fill from Solaris to some EPRVs rather than burst disc, allowing operators to continue to handle some pressure events a little bit without disrupting operations. One of the ones that's pretty big is simultaneous dual fracturing. Not every oil and gas operator can benefit from simultaneous dual fracturing because they don't have the layout and the spreads and the logistics to be able to handle it. But on the left-hand part of this exhibit here, you see that more and more respondents and operators are trying it. And you can see that the Permian Basin is really the region that's really benefiting the greatest. And the efficiency gains are really quite pronounced at about the mid 20% range. And so in addition to efficiencies from simultaneous and some of these other technologies, a lot of the oil and gas operators are continuing to prefer dual fuel, electric starting to gain prominence. All of this provides benefits of displacing the cost of diesel fuel. Other operators prefer diesel because it's what's available. They don't have electricity or gas. They're very familiar with it. And when we ask the oil and gas operators where they'd like to see the service providers continue to invest to improve and drive this industry even further forward, it's true. They do want to see continued investments with e-fleets and dual fuel, but a lot of it's just basic blocking and tackling. Work on your basic equipment maintenance and uptime. We're running 24/7 operations. Figure out how to be more innovative to pull your pumps out of the line without sacrificing the frac process. And so to your point earlier, Andrew, even though there's a lull in activity right now, this lull is almost like a gift. We can't grow at 30% every year.
No, it's not sustainable.
So we're going to use this time to kind of focus on operational excellence, operational execution, and efficiencies. Some of the other trends that we see in the industry too is when we ask the operators, where do you get your biggest benefit? Completion efficiency is at the number one top of their mind. So regardless as a supplier, if you're integrating services, be it chemicals or proppant or perforating, or if they're using dual fuel, if you're like a next tier and you're in a Liberty and you're bringing gas conditioning, compression, and transport, those are all well and good. And some operators see value in it and others prefer not to participate in bundling. It's all driven around improving completion efficiency. And then lastly, we do see water consumption increasing. We see recycled water increasing, which has an impact to the frac iron. Brown sand is leveling out. Wet sand's beginning to be more used more and more as people try to trial that. 100 mesh sand is still king. And we continue to see the use of dissolvables continuing to increase ever so slightly, with about a third of operators planning to increase this. And so, just really quick in summary, if an operator can shave a day off drilling a well, and they drill 100 wells a year or 500 wells a year, that saves 100 to 500 drilling days. And all of this adds to being able to accomplish more with less. And so while maybe it's a little bit troublesome to see the low rig count, the production levels haven't quite followed just yet. And they're probably going to go down. But I agree with you. The rig count will have to go back up over 700 in 2024. To change gears maybe just a little bit right now, Andrew, we track the market and brand image of these suppliers. You seeing any changes out there with how these hydraulic fracturing service suppliers are being viewed?
Yeah, no. So I really like the bit we just spoke about there around equipment reliability and how much we're pushing the envelope. And so how is that reflecting in terms of how service companies are being perceived? So let's look at this here. Let's look at Halliburton and their brand image, right? And brand image can go to the left or to the right. And by that, what I mean by that is, if you're way out here on the right, like Halliburton is as a technology leader, that means that view of Halliburton extends way beyond their own customer base. So even people who don't use Halliburton on a regular basis, they understand that Halliburton is seen as a technology leader. And they've held that position pretty consistently for the last 3 years.
Go big bread.
Exactly. Conversely, even Halliburton's own customers will say, look, it's not viewed as a low-cost provider. You get what you pay for, and that's the inverse of relationship as a technology leader. So that's what we see with Halliburton overall. We go to another member of the big four, Liberty. Now, this is a great brand image for Liberty overall. They're way out here to the right, beyond their own customer base in reliability, technology, field personnel, technical support. Again, not seen as a low-cost provider, but they're getting this brand image that goes beyond their customer base. But Halliburton and Liberty have been relatively, I would say, consistent. In terms of people we've seen starting to shift a little bit, next year would actually be the one I'd be looking at overall. And they've started to make some moves. You know, if you look last year in 22 in the gray bar here, really a negative on the reliable equipment. Their own customers questioning that value proposition. And even though this is a zero, that's a significant move to the right in a positive direction for them. They've moved up in technology leadership, field personnel, technical support. What does that translate into? We go to the bottom of the chart here. Cost more, but worth it is now creeped into that positive as they start to position themselves as more of a premium supplier overall. So we've seen moves from next tier. Now, ProFrac, they are exhibiting some brand image deficits right now. We can see that very clearly on the chart, but I would say that there's been a lot of movement within that organization. The acquisitions of, you've got FTS International, USWS, you've got Sand Mines. So an awful lot going on with ProFrac right now, and I expect them to address a lot of this going forward. Universal, I think what's going to be interesting about them is that tie up with next year and how that changes things going forward. And then Calfrac, the bigger Canadian company, really the big thing for them is technology leadership. A lot of that is to do with the fact that they're really just a diesel provider. They don't have dual fuel or electric. And so from a technology development standpoint, they're seeing as, providing that value on the diesel side of things. So from a brand image, an awful lot going on, but next year is certainly the one that's been making a lot of moves. Big Red and Liberty have been consistent. Okay. ProFrac's got some ground to make up.
That's good to see.
So, that's brand image. And that's what we're seeing in the marketplace. But, what observations are you seeing in terms of the competitive landscape, in terms of market share or providers that's kind of reflecting overall?
Sure. Based on the actual customer reviews, what we see in the marketplace is the market has been consolidating in the U.S. land market for hydraulic fracturing. If you go back to 2016, Big Red and Schlumberger really comprised about 43% of the market, and the majority of the market was heavily fragmented in the hands of 29 different other hydraulic fracturing service suppliers. Move forward to 2023, we have moved from 31 suppliers, but we flattened out around 21, 22, 23 suppliers. So the good news for the oil and gas operators is you have lots of choice. But now the big four suppliers, Halliburton, Liberty, ProFrac, next tier, soon to close with Universal in Patterson. Once that transaction closes, these big four will have about 72% market share. Now, what does this mean for oil and gas operators to have four huge tier one suppliers? They're capable to invest in scale and next-gen technology. You had mentioned Calfrac, very value-added, but it's really difficult for Calfrac to continue to invest at the scale that the big four can. And so, there's some really big opportunities for the operators to really evaluate these suppliers and understand the strengths and weaknesses of all of them. When you go into Canada, we find that Trican continues to have market share leadership, followed very closely by Calfrac, Liberty, and Halliburton. And this is the part, Andrew, that is probably the most intriguing to me because, and I want to thank again all the oil and gas operators that participate in our surveys, because because of your gift of feedback in rating the performance of the various hydraulic fracturing service suppliers on a scale of 1 to 10, with 10 being excellent and 1 being poor performance on these performance measures, responsiveness to needs, equipment quality, competency of field service personnel, technical support, availability, completion efficiency, and pricing competitiveness, we see quite a bit of variance in the performance of the hydraulic fracturing service suppliers from the eyes of the operators. There's certainly no evidence to suggest that all these hydraulic fracturing service suppliers are performing at the same level. which then creates an opportunity and a challenge for the operators to really do your due diligence to seek to understand the strengths and weaknesses of the various suppliers. When you look at the industry average performance reviews, overall as an industry, we're improving. The ratings are improving year on year. We rolled over pretty heavily in 2022. As you pointed out earlier, Andrew, we grew at over 30%, and everybody was stretched to the hilt. When you look at the customer reviews, you'll see that Halliburton consistently performs very solidly in the eyes of the end user around equipment quality and technical support and completion efficiency. Liberty continues to get very favorable customer reviews across just about all the basins. And as you pointed out, NexTier's image is improving for equipment quality and technical support and others, and we see their actual customer reviews improving. So what does this look like when we look at the competitive landscape? What we find is that overall, amongst the big four, Liberty and NexTier are value advantaged. You mentioned ProFrac's going through a lot of transformation right now, and their value proposition is beginning to be challenged just a little bit. And then, of course, Halliburton, we'll talk more about them. But when you open up all these other small to independent suppliers, you start to really see ProPetro very well positioned as a value advantage supplier. Their position has basically stayed very similar to 22. It's declined from 21. ProPetro really stands out for very high scores for customer responsiveness. Field service meets industry expectations. Their completion efficiency ratings, however, tend to rate below industry average. CUD has moved from a discount provider to a value advantage provider after underperforming industry average for the last 2 or 3 years. But they too have an opportunity to improve completion efficiency. STEP is also viewed as a value advantage supplier, and Universal and Calfrac are certainly viewed as meeting industry expectations and delivering solid value. When you really look at Halliburton, they really stand out in the Permian Basin. This is where Halliburton's really beginning to flex its muscle, because here they're clearly viewed as that premium supplier. Costs more, but worth it. Liberty has given them a run for the money. But when you really peer in more closely with Halliburton, what you really find is for those oil and gas operators that have high intensity completions, say 60 plus stages, 12,000 plus foot laterals, this is where Halliburton is really distinguishing themselves. Operators drilling 100 plus wells, they see great value in Halliburton, and Halliburton's living up to that image that you just said. They cost more, they're worth it, they're technologically strong, and that's really where they stand out. Liberty has really good sweet spots between 40 to 60 stages and 10,000 to 12,000 foot laterals. My point here is to the oil and gas operators is each of these hydraulic fracturing service suppliers have particular strengths and weaknesses. And as an operator, you really want to figure out where you're going to get best value for your operation. So I really encourage the operators to continue to partner and conduct your due diligence in talking to the hydraulic fracturing service suppliers to understand where their strengths and weaknesses are, to make sure that you're going to get best value and that you have really fit for purpose. And so, with that, I think I'll wrap it up with that, Andrew, on that. And maybe the next thing to do would maybe to talk about, I think the perforating report's going to come out next week.
Next week, yep.
And Frac Trees, I think, were published this week. Do you have any insights that you can share with the audience, even though the perforating report's not published yet?
Preliminary thoughts,
yeah. What are you seeing there? Because a lot of the times the hydraulic fracturing service suppliers have been acquiring the perforating to bring those completion efficiencies to bear. So what are you seeing out there?
Yeah, so as you said, we just published the Frac Tree report, and the perforating report is going to be out next week. So let's start with trees as we've published that. One thing to really say about Frac Trees is that although we're showing sort of 8 to 9 different service providers here, it's actually 36 unique suppliers of Frac Trees we picked up in our most recent study. So this market is still very fragmented overall, and that's a key thing going forward. The other thing I'd say is that when we look at likely to want to use this frac tree supplier, What's going to drive that? Equipment quality and reliability. Again, it came through. We spoke about it earlier. The intensity, the efficiency. Are you reliable? When it comes to the value proposition, what we can very clearly see here is that, Technip FMC, they're in that sweet spot of the premium provider. We've got a whole host actually down here of SBM and Volt who providing above industry average performance at attractive pricing. And over here in the top left, we do have some service providers who are being challenged on their value proposition. So it's a bit of a mixed market right now. But I think the key thing for me on this is that 36 unique suppliers and the fragmentation.
Well, that's a lot.
When it comes to perf, and again, this is preliminary, so coming out next week, we'll have a quick look at Liberty here. Liberty's done a great job of aligning more around their frac and their perf. You can see the wireline perf and the frac. They're now very much in alignment from a performance standpoint. Pricing maybe needs to get together. Halliburton, very tightly clustered, the frac and the wireline perforating, viewed very similarly, but they are being challenged on their value proposition overall. And then I'll briefly touch on NexTier, which has a great kind of segmented strategy as were with the wireline perforating and the frac all sitting in the fair value fairway, and they know what they're offering and they're going to market with overall. So
that lines up pretty nicely.
It lines up really, really well. So that's kind of what we're seeing in the perf and the frac trees.
Any insights on ProPetro and the Permian?
Yeah, we got ProPetro.
Because they just picked up Silvertip.
Yes. So ProPetro, we can see very clearly down here, they're perforating, again, and the same with their frac, above industry average. They're providing value. Is there some pricing opportunity for them? Maybe. We'll see overall. Certainly the feedback we got was that they are providing that service at pretty attractive pricing.
So from the operator's perspective, the ProPetro matchup with Silvertip is very much value creative from the customer's perspective.
Value accretive completely.
I was just notified that I was not paying much attention to our Canadian neighbors, and I skipped right through Canada. So I'm going to back up just real quick and mention that up in Canada, I mentioned Trican's the market share leader, and they provide great market discipline and pricing discipline for the market. Calfrac is long-term Canadian provider, is viewed as being value advantaged. Liberty and Halliburton are both competing pretty much toe-to-toe, quite frankly, in the Canadian market. It's clear, again, that the operators see differentiated value in the Canadian market, just like the operators in the United States see differentiated value as well, okay? And this is the Permian Basin map where, again, when the operators see differentiated value, this is really nice. It means the operators have choices. Obviously, high-intensity completions, maybe go to Halliburton, maybe a simpler completion, maybe you can go to another value-added supplier. And that's what I was trying to highlight here is, for folks that are, drilling, say, was this Halliburton 60% stages?
60+ stages, yep.
So some of the smaller oil and gas operators that are drilling less than 20 wells right here, Andrew, they're challenging Halliburton's value proposition. They don't quite see it. What they see is they see greater value in some of these other hydraulic fracturing service suppliers. So I wanted to make sure I covered Canada. And while we're wrapping up on this part here, internationally, obviously the market consolidates quite a bit. But Halliburton's, again, Big Red's very solidly positioned internationally. Schlumberger's kind of positioned SLB as more of a premium-based supplier internationally, and Baker Hughes more of a value-based discount provider internationally. So that kind of wraps that part up.
Now, and David, I think we've mentioned real quick consolidation or fragmentation at least half a dozen times.
Yeah.
We've got the Patterson Universal and NexTier transaction closing sometime in the second half of this year, maybe even the third quarter. Do you see any other need for consolidation or other thoughts around that in this market at this point?
I do. I think the consolidations that have occurred to this point have been very healthy for the market, not just for the oil field service community, but also for the oil and gas operators, because these big four suppliers that we've talked about, Halliburton, Liberty, ProFrac, and now Universal and NexTier coming together, it allows these companies to be able to invest in next generation technologies and dual tier 4 dual fuel and electric frac fleets. Last mile technologies to keep driving these completion efficiencies. for some of these really good value-added other suppliers, be it a ProPetro or a Calfrec or a Step or a Trican, and there's so many others that are out there, it's harder for them to scale up. Calfrec's a great value-added supplier, as you mentioned, conventional diesel. And as those conventional diesel fleets begin to retire out, they're going to replace them with Tier 4 dual fuel, which is what they want to do and should be doing, and they will do it. And that's great for the industry. But it's going to take some time for them to do that. There's only so much capital to go around. And so being able to have these anchor big four suppliers to provide the discipline to the market, but also to provide the investment scale to the market is very healthy. The operators will certainly benefit, as we just talked about. We're drilling faster, we're completing faster, we're producing more oil and gas today with fewer rigs and frac crews in my 36-year history in this industry. So I'll leave it to that. Maybe to wrap things up, Andrew, how do you see the rest of 23 stacking up, and any plans for any reports coming out soon?
Yeah, so 23, I think we touched on it earlier. If oil stays in this kind of 80 range, then I think we're likely going to see some private E&Ps potentially jump back into rig count at the end of the year.
We're hearing that, yep.
Regardless of that, I think that rigs have got to go back above 700. At the end of the day, pricing's relatively stable. There is some softness in the spot market, but when you talk about a service company, capital discipline, I know capital discipline has really been a phrase for the operator community, but certainly we're hearing that amongst the service company community. And then those focus on those operational efficiencies, it's a relatively stable pricing market. And take a big step back to your comment at the beginning of the presentation, it's 80, but it feels like 30. The supply demand fundamentals are still pretty robust. There's definitely some weakness and some opportunity out there. Oil and gas pricing is good. I think we're going to continue to see good margins and good cash flows in the second half of this year from operators and service companies, and likely the same again in 2024. So it's still a robust and strong market overall.
So the discipline that we're seeing from the oil and gas operators and the discipline that we're seeing from the service providers is really healthy for the market and for shareholders.
Yeah. It's a steady, stable market, and everyone right now seems to be in a good spot overall. It's that expectations game, right?
Great.
In terms of what we've got coming up, if I just take a look at the next couple of weeks in August and September, perforating, as we mentioned earlier, we've got the artificial lift report coming out with ESPs, rod lift, gas lift, and plunger lift, production chemicals. That's going to speak to all of the major service companies, SLB, Halliburton, Baker Hughes, Weatherford, ChampionX, and many, many more. And then later on in the year, we've got cementing, wellheads, and formation evaluation. So a lot going on between now and the end of the year.
That's good. That's a lot to look forward to. I'd like to think, any questions or anything we need to address from the audience yet? Perfect. Well, in that case, I want to thank everyone for joining us today. And I also want to thank all the oil and gas operators who participate in these industry surveys. With your gift of feedback, we're able to aggregate and provide you these industry trends, performance trends, and technology trends. And again, we as an industry have a lot to be very proud of. When I first came into the industry in the 1980s, we were supposed to run out of oil by 2025, and that hasn't occurred. And, we continue to accomplish more together, working together innovatively to innovation, grit, and technology. So please continue to collaborate with your service partners, your oilfield service providers and oil companies. If you have any questions on anything that we discussed or anything you want to delve into more deeply, feel free to reach out to discuss. Hope you have a great weekend ahead, and thank you for joining us today.